Howdy, fellow economic hackers. Today we're talking about excess reserves of depository institutions, essentially banks, and we're looking at data from the Federal Reserve. I'm going to have a link to where this data is, as I do for all the data that I present in the blog. But I was looking at this chart, and as I said in the blog, from 1959 to 2008, excess reserves at banks was essentially flat. Less than $2 billion. Now I know $2 billion is a big number. I think it's a big number, but in today's numbers of a $16 trillion GDP or over $16 trillion GDP and an over $16 trillion debt, you know, what's a couple $billion? Anyway, what it represents in comparison to $1 trillion is very little. So we really have this flat line until 2008. And then in 2008, all of a sudden, there's this giant spike in excess reserves, you know, north of $1 trillion, and it's remained north of $1 trillion. Well, to understand what this means as far as excess reserves, we got to really understand what are reserves. So let's do that really quickly. So when I go to the bank and I deposit money, let's say I make a deposit of $100 at this bank. We're looking at bank reserves, not excess reserves, but just reserves. This becomes a liability. We'll talk about why it's a liability in just a second, but the Federal Reserve requires that 10% of this deposit, or $10, be held in reserve. Why is it held in reserve? Well, we're just talking about little old me in this bank, but let's say there's thousands of accounts, and I'm not going to take 100% of my money out of the bank each and every day, and neither is these thousands of accounts. So if you have 10% in reserve, then you have enough to cover the normal fluctuations of checks and deposits and withdrawals in order to handle the thousands and thousands of accounts that a bank has. And we'll get into really this reserve requirement of 10%. Although it's been around for a long time, the actual amount that banks reserve isn't really $10. It's actually less than that. We'll talk about that in another time. But the bank can loan up to $90. All right, so why is this a liability? Why is this initial $100 deposit a liability? Well, it's a liability because when I deposited it, the bank agreed to pay me so much interest on that $100, a yield, and at a particular interest rate. So from the moment I put this money in, the bank basically is going to pay me on that money. The asset side of the balance sheet, the loans or the potential loans in the reserve, and in this case, let's say the bank went ahead and loaned this money out, that $90 needs to be at an interest rate that is higher than what the bank is paying me. And it needs to cover that interest rate that the bank is charging, needs to cover this interest, you know, plus any expense of the bank, the rent, the people there, and hopefully, you know, it's enough to make a profit, for the bank to make a profit. So we have a reserve here, and that reserve is $10. But what we wanted to talk about is, you know, what is excess reserves? So let's talk about excess reserves. So instead of $100, let's say the bank has $1,000. So the reserve, 10% of $1,000 is $100. So we'll put that in here. And the loans, let's say the bank has, I don't know, let's say $180 out in loans. The bank clearly can loan $900. It only has $180. So let's see what we have in excess reserves. So we start off with the deposits of $1,000 in the accounts. The required reserve is $100, so we'll subtract that. So that gets us to our $900. And then the loans are $180. So basically you've got $720 in excess reserves. And why is that, you know, potentially a bad thing? Well, it's potentially a bad thing because you're having to pay interest on these deposits, which are liabilities. You only have $180 out there on loans to cover, you know, all of your costs. And that's why excess reserves up until 2008, were not a great thing. It was something that a bank didn't necessarily want to have. So we've got a basic understanding of bank reserves and excess reserves, at least what I understand about those two things. So now let's go back to the original question of why excess reserves skyrocketed in 2008. And for that, we'll look at the rest of the post.